If I found a purpose really in any industry and was adding value, that can actually turn into a passion over time, which would be less intimidating because at the time I was like, oh man, how am I going to find something truly that I love to do?
Welcome to the Build to Billions podcast, where we guide successful entrepreneurs and investors on their journey from millions to billions. We believe that the key to scaling your wealth and compounding your life starts every single day with a mindset and practice of stewardship over ownership. Our ultimate goal is to help you scale and compound your wealth and life so you can give more or all of it away to help MVPs. I'm your host today, Brett Swartz. In each episode, we're joined by some of the world's top millionaires, billionaires, and entrepreneurs. They share their principles, values, secrets, and wisdom, providing each of us with the insights we need to reach the next level of success, faith, and impact. I'm excited about our next guest. He's out of the Southern California region. He's the CEO of Morton Wealth, and they are here to help bring and help us build and create and preserve more wealth. He serves individuals and families and business owners on either whether they're curious about alternative investments or building wealth, or basically learning how to build what's called a disciplined investment mindset. That's what we're going to be talking about today. Please welcome to the show with me, Jeff Sarti. Jeff, how are we doing?
Doing great, Brett. Nice to meet you.
Likewise. And for our listeners getting to know you for the first time, would you give us just a little bit more about your amazing background? I mean, you guys got over $2 billion under management now, 50 employees, 1,000 client relationships, and you've got a fascinating background. It'd be great to hear from you.
Yeah, I'd be happy to give you a little background. And I'll talk definitely about kind of what makes us different, but maybe just for a little bit of context, we typically are the financial quarterback in our clients' lives. So, we'll help them on their roadmap to achieve their goals, whether it's towards retirement or some other goal. And that's across a variety of things. It's helping them diversify their portfolio, doing retirement cash flow planning, tax strategies, insurance, estate strategies, you name it. That being said, again, what really makes us different is how we invest and how we think about the world. And I think we invest in a very different way. And I think the way I'd put it is we are a voice or really an option for what I'd call a healthy skeptic. And maybe I could define what a healthy skeptic is, but maybe I'll start, if it's okay with you, of maybe defining what's not a healthy skeptic. So for like 90% of the people, they're really happy with the status quo, right? And there's nothing wrong with that, right? They're happy with what's worked in the past, they feel should work going forward. So maybe it's a 60-40 stock bond portfolio with a little bit of commodities and real estate, et cetera. And the lion's shares of firms out there, they serve those needs well. There are plenty of excellent firms that do just that. Now, on the flip side, there's potentially 5% of the population. This is still not quite the healthy skeptic, but maybe they're more like doom and gloom, right? Maybe even mixed with a little bit of conspiracy theory in there. So they're going to be all in cash or maybe very heavy in precious metals and maybe shorting the market. So then there's this third category of people that I go back to what I think is the healthy skeptic that I think straddles those two groups. On the one hand, they're more optimistic, right? They're like the status quo and they want to participate in the economy and be invested and generate healthy returns along with the growth in the economy. But then on the flip side, like the doom and gloomers, they have what, again, I'd say is a high degree of skepticism on the markets, the economy, et cetera. I'd say starting like with the stock market, I think they're very skeptical of the stock market. We, of course, invest in stocks, but we have less than most traditional managers because with our healthy skeptics, I think there's a lot of concern around the stock markets. They think it's more than anything a popularity contest, not really driven by fundamentals. Element of gambling, it feels like sort of a casino type environment. So I think they're skeptical about stocks. In addition, I think they're skeptical about economic statistics. Simple example would be like inflation statistics, right? We all know that reported inflation over the last several decades is lower than actually when you go to the grocery store. And then the last point that I'd say they express some degree of skepticism, it's around policy. And this is the biggest issue and concern for us. Talking about monetary and fiscal policy, a lot of concerns around the imbalances out there. So whether it's 15 years of 0% interest rates, money printing galore, or our debt levels that are just absolutely out of control on the fiscal side, I think, again, our clients come to us, they're not economists, but they intuitively feel that there's no free lunch and there feels like there should be a cost to some of these policies. And as a result of that, they want to just build a somewhat of a more resilient, diversified portfolio than you can find in traditional sort of status quo land.
Awesome. We're talking with Jeff Sarti here, and you can learn more about him by going to mortonwealth.com, mortonwealth.com. And all really good thoughts. I wrote down that healthy skeptic. I like that. And so in today's episode, we're talking about the disciplined investment mindset, right? And how to have a healthy, how to use healthy skeptic mindset as well to make, prudent decisions. Before I dive into that though, Jeff, I do want to take one other step back. I believe we'd all be given certain gifts in this life, and these gifts have been given us to be a blessing, help to others. Some people call them superpowers, some people call them strengths. I'm curious, Jeff, growing up, what was the one or two strengths, that you just kind of just innately had? And how does that help how you help and bless people today?
Wow, that's a great question. I think a couple things come to mind. I think I just naturally, uh, I'm a pretty empathetic person. You're making me uncomfortable, Brad, talking about myself like that. But empathetic person who I'm able to step into others' shoes pretty well. And I think from when you're dealing with clients as an advisor, um, people are tremendous amount of emotions when you're dealing with money and net worth and your nest egg. So I think that empathetic lens helps to a large degree. And then the one other aspect I'd say is a comfort with, as I alluded to in the first part, of veering from the status quo. I think a lot of people feel safety in following the herd in the status quo, and I'm very comfortable leaning outside of the status quo, not just to be different for different sake, but if it makes sense for reasons I'm sure we'll get into to veer from the status quo, we definitely lean into that.
Perfect. It makes perfect sense. I'm so glad I asked that because it's going to help in our conversation here. So let's dive into the number one secret to a disciplined investment mindset. What would you say that is, Jeff? Go.
I would say from a very high level, it's really embracing a long-term mindset as opposed to a short-term mindset. And I know that sounds simple, but when we think about investing at large, so much of our society, the media, our industry really promotes short-term thinking. And even just backing up a little bit from a high level, if you think about what the word investing means, there's going to be some element of sacrifice and time, discipline associated with even that word. If you think about investing in your career, your health regimen, your passion, your charity, your faith, whatever it is, that investing takes sacrifice and time and discipline. Yet with investing your net worth, the actual investing your dollars, I think we're just naturally wired to try to take shortcuts and lean into short-term silver bullets. And that's just a real frustration of mine and of our firm. I think the media really leans into that, right? Everything is advertising on TV, the latest stock of the day, best or worst performing stock, what sector to chase or avoid, what is the Fed going to do tomorrow in terms of raising or lowering interest rates, everything's short-term data. And then I think our industry really promotes this as well. Our industry really promotes forecasting. Everything's a forecast, right? We're going to see now in December as we're recording this, we're going to see all sorts of articles coming out on what's going to happen in 2025, right? What's going to be the next quarter or year? What's going to be the best performing sector? I think all of that's really reinforces short-term thinking, a trading or speculative mindset, as opposed to more of an ownership mindset that we try to embrace for our clients in terms of how they approach their portfolio.
Okay, they got it right. So embracing long term versus short term, right, and not getting caught up in the media frenzy, pushing today, right, and chasing those things. That makes sense, and it's just a basic concept of that it does as well. Sacrifice and time.
Mhm.
Okay, so then what's the next secret to having a disciplined investment mindset?
I would say it goes back to even the comments around status quo and a willingness to look different from the herd. This goes down to one of our real areas of passion. It is around thinking about portfolio construction in a different way. It's specifically diversification. Um, all of the science around diversification, it was great, but it was all mainly created, call it in the 1950s, University of Chicago, Summit Wharton. And it was really around stocks and bonds and maybe mixing in a few other asset classes. But I think a lot of it really needs to be brought up to the modern age. And what I mean by that, even let's just say starting with stocks. Most people think, oh, if you have a diversified portfolio of stocks, let's say 20, 30, 40 stocks, maybe mutual funds, ETFs, you're plenty diversified. The problem with that approach is that it's looking at the wrong data, I believe. Most of the data 70-80% of the data are comfortable or upward moving markets where that diversification does ring true. Stocks will behave differently in upward moving markets. But the truth is, the only time you really need diversification, it's a concept of not putting all your eggs in one basket, is in downside markets. Market recessions, bear markets, times like 2008, 2000, etc. And we all know what happens in those environments without getting too technical, but correlations go to one, meaning all stocks move in the same direction. So we strongly believe that even if you have a broadly diversified group of stocks, that really doesn't result in the resiliency that you need for your portfolio. Because again, you're trying to protect in tough economic environments, and stocks don't do that. Then to take it one step further, bonds. Again, we've been so lucky and blessed, spoiled over the last 40 years of a declining interest rate environment that bonds have been a wonderful diversifier. Again, we don't believe not the case going forward in a choppier interest rate or inflationary environment. We don't think bonds are going to be the diversifier they were looking at as compared to the last 40 years. So long story short, what you need is you need a lot of other asset classes. Real estate would be one example, but there are plenty of others as well where at its core, when we are thinking about diversification, we're thinking about two aspects that we're trying to diversify around. Most assets are correlated with the economy, that's GDP, and or interest rates. Stocks and bonds both do well in a growing economy and a comfortable interest rate environment. They do poorly in the reverse. So what we strive for is to find asset classes, niche opportunities that will do okay, even if we hit a speed bump in the economy, i.e. a recession, or if interest rates are volatile or move up from here. So that's what we try to really incorporate in the client portfolios.
Okay, Jeff Satara here. Did I pronounce that right? Jeff, yes, Sarti. Sorry, Jeff
Sarti,
Sarti
yeah.
here. Again, mortonwealth.com, mortonwealth.com. All right, so that concept is interesting to me. Diversification, I haven't quite heard it put that way, but that makes
Mhm.
some sense. It sounds like the overall thought is in an economy that is growing and doing really well. It's the right diversification at the right time, I guess is probably the way you put it there, right? And so knowing when to use which side of how to use diversification, I guess is a good way to put it. Jeff, did I miss that?
You to some degree you're correct. I think to more degree, I would even take it one step further. I think because we truly have no crystal ball, timing is a tough element. Uncertainty is a constant in the world of investing. That you really need to have, we believe, a robust, diversified portfolio in all environments. Don't get me wrong; we're always going to tweak position sizing and sector rotation depending on our shorter term view of the world. But that's actually a smaller part of what we do. We just want to build a more resilient portfolio in all environments because it's the nature of uncertainty. By definition, we don't know what next year is going to hold. Is it going to be a good economy? Is it going to be a bad economy? Is there going to be some catalyst on a geopolitical scale that we're not aware of that can throw things awry? So we want to be really strongly diversified, really in any economic environment.
Okay, so let's make this a little bit practical, and this is gonna be a little bit of a hypothetical, but I want to try to bring it, to a little more tangible here, and then we'll keep going and we'll keep digging in here. So, I'm 55 years old. Let's say I have a high risk tolerance. I'm thriving. I'm worth $10 million. And I'm coming to Jeff, and I'm saying, Jeff, I mean, most of it in business and real estate. Of course, I've owned some stocks over the years. Right. And it's, talk to me about some rough percentages, right? And I don't necessarily need the cash flow right now. I'm more so focused on growth, of course, and preservation, and being able to sleep decent at night, right? But I have a higher risk tolerance. Like I'm not overly, dependent upon this kind of capital. If I came to Jeff, you mentioned real estate is one of the alternatives, right?
Yeah,
And then
definitely.
some stocks, and you mentioned some bonds. What if I $10 million, Jeff, roughly what percentages would be in what?
So listen, it is a wide range, but we would be rough percentages. Let's say I'll start with stocks. Again, most with that profile would say, oh, that because they're a high risk, growth oriented portfolio, they should be 60, 70, 80% in stocks. We would be a small fraction of that. We would probably be in the 20 to 30% range. And I'll just stick on stocks for one sec because I think it's an important point. we don't have a rosy outlook on stock performance going forward, and it's simply a valuation argument. From a long-term perspective, the most important driver of long-term returns for the stock market is valuations, like period. More important than the economy, more important than trends, more important than interest rates. When you start with cheap valuations, your next 10 years of returns are going to be great. When you start with poor valuations, i.e. high PE ratios, and we are in, I would say, extremely high. The only time that's exceeded this is really the 1999 dot-com bubble. Then classically speaking, returns are not going to be as rosy. And even just independently, this isn't just me saying this. I know Goldman Sachs just came out with their 10-year forecast. They said returns are going to be 3% a year. I think Bank of America might have said like 0 or 1% a year. I mean, and that's just because it's the math of high stock valuations. Bonds, moving on to bonds. Bonds will also be a low percentage of the portfolio, higher than they were in a zero interest rate environment. Don't get me wrong, but when bonds were basically 0%, we had almost nothing in traditional bonds. Now you can generate some sort of decent returns, but you got to be selective because, again, we think it's still a relatively low interest rate environment in the grand scheme of things. Real estate, depending on the opportunity, real estate's a little tricky, right? There's vulnerability, some potential volatility in the current environment, but that's theoretically where opportunities are starting to appear. And so we're excited going forward about some real estate opportunities. So I would say building a real estate equity position of 10 to 20% over time. We also have a large allocation to real estate lending, and I'd be happy to spend more time on that. But you're probably familiar in your audience with the bridge lending space, short-term real estate loans, always in first position. That's always sort of our core fixed income allocation. And then we even have gold. We could talk about that, some precious metals. But then the other aspects, we do a lot of lending outside of real estate, typically lending on hard assets or royalty streams, other contractual items. That's where really the diversification and lack of correlation comes into play. That depending on someone's illiquidity profile, if they're willing to take on some illiquidity, that could be a meaningful position in a client's portfolio, 20, 25, 30%. And the nice part about that is from a risk return perspective, we believe in this lending area in the current environment, you could kind of have your cake and eat it too, where you can generate high growth equity-like returns, but in a much risk reduced fashion, and generate income along the way. And you mentioned, this person might not need income, but still, all things being equal, we still have income because even if you don't spend it, you can reinvest it and help the portfolio grow in that way.
Okay, this is very helpful. Thank you for breaking that down. Yeah, I agree with you. Lending's been one of our go-tos for the last couple of years, especially because real estate was just, the valuations were just so high. Didn't make a lot of sense. You kind of knew you were buying at the peak if you bought 2 years ago. And so we've been helping people exit and do just that, go into mostly lending first positions, 45% equity built in, senior secure, senior mortgages, average net worth of, 5 to 7 million personally guaranteed. We've been doing that. We've been doing it kind of on the private REIT level, and likewise too. I think a lot of our clients, like stock market, has been kind of the healthy skepticism, right? They've had that either that poor experience and or just it's not where they want to swim, right? They're better swimming in the real estate business debt world than they are in the a world that feels like a little bit of fish out of water. Interesting. You said 10-year forecast, 3% on Goldman Sachs. That's fascinating on the stock side of things. And then, but I want to dig into this royalty stream. This is interesting because I haven't really kind of heard this before. So, I mean, wow. Okay. So tell me more. Like, are these, you say illiquid, how long illiquid on average, what's the average interest rate on these things? And, and what's the, potential risk with default? Cause I haven't ever really dove into this. So let's dive in a little more.
Yeah, there are all sorts of royalty streams on all sorts of asset classes. And from a high level, just hitting on liquidity, typically when we engage in lending opportunities, the real estate as you example that you made as well, the liquidity is actually pretty decent. Typically, there's some sort of lockup. Maybe it's a year lockup, and then maybe it's like quarterly or semi-annual liquidity thereafter, which we think is pretty good from a liquidity point of view. That being said, if you get into a little bit more of the niche royalty space where you're dealing with longer term sort of lockups, that has more of like a private equity like flavor. in terms of illiquidity, I should say, where you're shooting for higher returns, but you're in more from a partnership point of view for like a 5 to 10-ish year period, almost more like a real estate equity play. But again, we think with some downside protection. The area we've focused on a few areas of royalties, but the area that we're really most passionate and concentrated in is in the healthcare space. So one, we love healthcare as a sector. We think healthcare by the very nature is going to be more recessionary proof resistant. People need to take their medications, have treatments, surgeries, et cetera. Even if we hit a speed bump in the economy, that sector has proven to be pretty resilient. And specifically, this area of healthcare royalties, the classic story is it might be, let's say, a biotech company with a pharmaceutical drug fighting some critically necessary disease. Maybe it's an immunology drug with cancer. Maybe it's some sort of blood pressure medication, et cetera. So they have a drug out in the marketplace with regular, predictable sales. But what does this company do? They plow all their money back into R&D to try to come up with the next drug. As a result, they have negative earnings. So even though this company is very successful, they have negative EBITDA. So they have difficulty going to the market to raise money, whether the debt markets or they don't want to dilute and sell equity. So there's this third option for these types of companies where they can, in essence, sell off a piece of their drug that's out in the marketplace, sell X% off for an upfront check where they can fund their R&D. But now we, as the owner of the royalty stream, own a percent of that drug stream going forward. So one of the reasons we love this, one of the main reasons, going back to diversification, going back to our conversation 10, 15 minutes ago, not exposed to GDP growth, really interest rates don't really matter. If someone needs to take their drug for X, Y, and Z reason, they're going to take it no matter what the economic environment. And now going back to risk reward, there are only a handful of players in this space. As you can imagine, this is a very niche space. I mean, these are very sophisticated groups. They have PhDs on staff, et cetera. You have to understand patents, competition, all of that. And the truth is the risk reward comes in all shapes and sizes, from pretty risky and speculative to on the more conservative end. We tend to veer towards a more conservative end with groups that really are thoughtful on structuring, where in essence they own, let's say, the lion's share of the sales in downside scenarios, but give up some upside. So if sales disappoint, you're still going to be okay as long as there's a big cushion. It's almost like a loan to value type argument on the lending side. So long story short, at least to date, it's been very resilient, really limited downside, and you're shooting for the lockup. You're shooting for, call it, private equity-like returns. Those are the types of returns you're looking for.
I like it, Jeff. I like when I find something in this niche and that you explained it so well. Obviously, you know it in and out. MortonWealth.com. So I have a concept that I've been working with and with my clients and thinking through, and I call it kind of like a 3D approach to investing in a mindset, right? So it's not just about cash flow. It's about tax flow, and it's about debt flow, and trying to get time on your side to be able to take advantage of those things. In other words, it's a good time to go into debt, right? Like right now, real estate values have dropped quite a bit, right? Especially multifamily and commercial. Yeah. I think it's a good time to maybe be a little more aggressive on debt, even though debt's a little bit higher, but you're going to get prices that are down by maybe 20, 30, 40%. Now, the flip side, it was not a good time to be in debt a couple of years ago because valuations were through the roof. And if you're doing these 1031 exchanges, you're just, trading for higher and you're doubling down, and then you're stuck in the illiquid asset. That's why we're not a big fan of the 1031 when it doesn't make sense on a high market. As well as cash flow is king. It always is king. But if you don't have the depreciation to offset,
yep,
and if you're not using things like real estate professional status, and you look at this $36 trillion of debt that the government has spent us as the taxpayer into this problem, you've got to look at a 3D approach. And so we specialize in helping business owners exit their business, their stock, their Bitcoin, their real estate, defer the tax, and then unlock these three things in a very flexible tax deferral strategy. But I'm curious, when you hear tax flow, debt flow, and cash flow, what comes to mind, and what are some ways to try to get those threes to converge in a meaningful way?
I love how you articulated that. And I've listened to a few of your podcasts in recent weeks where you've shared some of those strategies. And Listen, I'm not going to have a silver bullet beyond what you said. It's part of the reason we love real estate equity in particular so much. It's a core piece of what we do. And to your point, for the last several years, we've been even though we participated in real estate equity, we've been concerned around valuations. And so we've been really thoughtful around the debt piece and sized it appropriately with the groups that we partnered with. All of a sudden, with this dislocation, the rise in interest rates, we're starting to see opportunities. And it feels like it's been forever that we've been really super excited about these opportunities. But to your point, now it's a shift of mindset where it's like, all right, turn on that opportunistic sort of part of your brain that it feels like it was shut off for us for quite some time. We were very much more in the conservative side of things, low on debt, leaning more on the lending side. So just even actually embracing debt from that point of view as a debt provider, but then not leveraging up our equity. So now, for the first time in several years, we're really, really thinking about that differently and putting on that opportunistic hat, if you will. So, I mean, real estate is just a wonderful, wonderful solve from that point of view.
Excellent. This is great. Okay, let's keep going now. Let's dive back into the topic, which is which we're all along, but just I guess the third secret here. I mean, the first secret was embracing long-term versus short-term
Mhm.
thinking and investing, and then number two is the status quo, willingness to get away from the herd, right? And then I guess number three here is really looking and understanding some of these things that are maybe outside a little bit more niche,
Mhm.
and that could help. That's still going to be healthy within the economy or interest rates. So I guess what's the next maybe secret or thought, or maybe the thing I haven't brought up yet for having a disciplined investment mindset?
Man, there's so many topics to hit on around mindset, and we talk. Our mission as a firm is to empower better investors, and so much of it is through education and conversations like this. But our formula, and we have a very simplistic formula, it is right mindset plus right strategy equals a better investor, and that order matters. It really does start with mindset, and it comes down to, I mean, listen, money and emotions are so interlinked that it's being cognizant of your emotions and being able to compartmentalize them. Um, listen, we're victim to all of them. I'll give like even one simple example. Uncertainty. How we deal with uncertainty as an investor, I think really drives healthy versus unhealthy investment behavior. And what I mean by that is uncertainty is very unsettling. And especially when the stakes are high, and that, let's say, with your net worth, when faced with uncertainty, how do you react? And how many people react is they try to exert control, right? They try to outsmart that uncertain future. And the way they do that typically, it's through forecasting and prediction, right? And again, I shared this earlier in the podcast, but one of my big frustrations, and I think our industry preys on this, on insecurity around uncertainty, is our whole industry promotes forecasting, right? Every white paper, every advertisement, it's again around short-term forecasting. And this is so top of mind because I was just looking at a paper yesterday where it was reviewing 2024, and it showed all of the big banks, the 30 biggest banks, their expectations for stock returns in 2024. And the range was like 0 to 15%, right? What did stocks do? They were up like 28%, completely outside of the range of any of the 30. Go back to 2022 when stocks were down 18%. I think the worst forecast was like down 1 or 2%. My point being, this is such wasted energy. Our whole industry, and now as a result, the average investor spends so much time trying to outsmart their uncertainty through this forecasting and trying to outpredict or outsmart the market that we just take a very different approach. Instead of trying to outsmart the market, this again goes back to diversification. We lean into that uncertainty, somewhat humbling, but we acknowledge we don't know what the future holds. And then, so with that mindset, the result is instead of spending energy on forecasting, we spend our energy on trying to uncover opportunities. That's all we do all day long. And trying to build a bigger boat, if you will, trying to withstand the storm and create and find these diversifying strategies to make for more resilient portfolios.
Okay, this is excellent. So I got to touch on Bitcoin and just the thought
Yep.
of investing in that and it becoming, it seems like even more and more mainstream these days. So, hey, what's your thought on that? Has it changed from 2 or 3, 5 years ago? And, you know, are you having clients invest into Bitcoin ETFs and such?
So we are not currently having clients invest in ETFs. And I will say I have I'll just be frank and honest. I have sort of mixed emotions, both on the pro and con on Bitcoin. From a high level, um, I believe in the fundamental reasons for why Bitcoin has captured the imagination of a lot of the investing universe. And what I mean by that, just as a simple example, is we have been investing in gold as a core part of our portfolio going back to call it 2015. We're very concerned about the money printing back then, 0% interest rates, but now the debt levels. Paper currencies are obviously very flawed. And so gold as something you can't debase as an alternative currency is something we're very passionate about. And we think everyone should have that at least as a small component of your portfolio as an insurance policy against the debasement of paper currencies, namely the dollar. So from that point of view, Bitcoin in particular versus the other cryptocurrencies is an interesting alternative to gold and is intriguing. And so that's something, while we spent a lot of time on it, we haven't allocated to, at least as of yet, because we think gold suits that purpose in client portfolios. And I'd like to think there's a world where both Bitcoin and gold can exist. Now, that being said, as we're talking and Bitcoin just goes to the moon and is north of 100,000, my concern, and the reason I struggle to figure out if and when we would ever dip our toe in the water, is I have no idea how much of that price is just purely speculation. What I mean by that is, Dogecoin as an example. I don't even know what the market cap is now. I think it's like 60 billion. It's worth more than Ford. I'm not certain about many things, but at a certain point, I feel pretty strongly. I don't know if it's next year or 10 years from now, but Dogecoin will be worth zero. And until that and these other cryptos that are really worthless go to something closer to zero, I have no ability to assess how much of that $100,000 price in Bitcoin is artificially propped up by that speculative fervor that the populace is just chasing price. Long story short, my concern is that 99% of people are buying Bitcoin not because of this conversation I'm having with you around gold and soundness of currency, etc. They're just chasing price. That concerns me. That's a tough investment for me to get excited about.
Yeah, I'm learning along the way, and I personally invest into Bitcoin and a few other alternative coins,
Yeah.
and I'm studying it. Like we mine some Ethereum with the kids, understand it, like try to teach them like, hey, you hear certain things you can do to create wealth and revenue, and try to make that a tangible thing. And I've seen clients do tremendous with it, and we had a client we've helped exit though at the same point and diversify out of a $5 million position that she had bought for a much lower price, defer
Yeah.
the tax out of California where we're both from, and then be able to diversify that. And so back to the tax flow, cash flow, debt flow, and the timing of things. Let's shift into capital gains tax. I'm curious. Nvidia stock is one of them, right? That's kind of, really been a huge winner here the last 5 years. And other, real estate or business exits. When someone comes to you, Jeff, and they're like, man, I've got a huge capital gains tax if I exit. I'd like to diversify and work with you, Jeff, but I'm selling a business or real estate or Bitcoin. I want to diversify it. Where do you go with that as in your profession? I'm kind of curious. We work with some financial advisors across the country, but what's been kind of either your go-to or how do you come alongside of those clients that are looking to exit?
Yeah, listen, some of those conversations are challenging, right? Because none of us want to pay taxes, and depending on the size and concentration of a position like Nvidia or Bitcoin in a client portfolio, that can even become more challenging. So there's lots of different strategies, whether, exchange funds, you can do options related strategies around these positions, et cetera. And we've dabbled in those depending on the right scenario for a client. But the truth is, we try to keep it simple. Um, Again, we've talked so much about diversification that compared to most advisors, diversification is a starting point for us that we have to get the client comfortable with. If they're taking on too much concentration risk, they have to be comfortable embracing at least a trim on a regular discipline basis over at least a few year period, or else in all honesty, we're just not the right fit for them. And that's okay. And that's okay. We don't let the tax tail wag the dog, if you will. Again, but it's every client's position is different. If it's a 10 or 20% position in a client portfolio, that's much easier and we can be more patient. If it's a 30, 40, 50% position in a client portfolio, we're going to exert some more pressure and really generate some taxable gains, but hopefully replace that with some more resilient, non-correlated income producing opportunities along the way.
God, that makes sense on the stocks, but what about like if they're selling like a big, like we did a $13 million, car wash sale out of San Diego. We did $8
Yeah.
million primary home out of Palo Alto. These weren't, these were their businesses, their activities, and they want to diversify and they're ready to harvest this thing that they were in for a very low basis. So what about that? Do you come across those? I'm always curious, what again, if folks that are in your position are looking at when it comes to those kind of things, and then being able to unlock and manage the capital in a diversified way like you do.
Yeah, that's where more complexities, especially around the estate planning point of view, come into play, where you can have some creative strategies. But again, this adds complication to clients' life. But this is especially in real estate where you can be creative with certain ways where you can create LLCs, bring in limited partners within those LLCs to create certain tax advantages, deferral mechanisms, etc. A lot of it, though, you have to be willing to relinquish control to help on some of those tax issues. So this is where a lot of complexities come into play. And yeah, in one-off situations, we get into some of those more complex strategies. But the reality is, what we often find is once we kind of open up the hood and explain these to clients, they're like, "Oh man, is this really worth it?" And then they decide either to just keep it simple and hold it, or actually sell it and take the tax hit along the way. That being said, an area where we've only dabbled in, and I know you've talked a lot about in the past, is your tax, especially in real estate. There's some interesting tax deferral strategies, and 1031s are limited on a case by case basis. Maybe they work out well, but I know you and some other strategies. There's some other interesting tax deferral strategies, especially in the real estate realm, that I think are interesting ones.
Yeah, well, thanks for sharing that. Yeah, and people want to learn more about those opportunities. You can go to capitalgainstaxsolutions.com. You can check out the book as well, Building a Capital Gains Tax Exit Plan, where we dive into some of those options for you as a business owner, Bitcoin owner, stock owner, primary homeowner. Go to capitalgainstaxsolutions.com. That being said, Jeff, are you ready for the lightning round?
Let's go for it.
All right, no, now if you go back to your 25-year-old self, what's the one golden nugget make sure to tell yourself to do?
Oh man, rewinding back 25 years. I'd say it is what would be not confusing when I'm thinking about my career, not confusing passion with purpose. So what I mean by that is, like, as you think about like every college commencement speech, I remember it at my college, they were like, "Oh, find something you love to do, and then work won't be work." And so that was my goal. And the problem was I struggled with that, right? When I thought about what I like to do, it was things like when I was a kid, play sports, listen to music, etc. I'm like, how am I going to find a job where I have that much passion? And it was only later in life where through my work at Morton Wealth and financial services and what we do and adding real value that I found a purpose. And then that purpose ended up becoming my passion. So I guess long story short, if you find a purpose, and I wish I told myself this when I was 25, if I found a purpose really in any industry and was adding value, that can actually turn into a passion over time, which would be less intimidating. Because at the time I was like, oh man, how am I going to find something truly that I love to do?
Man, I love that. That's such a great, thoughtful way to think about that. Question number two: what's the number one book you've recommended or gifted the most in the past year?
Oh, uh, Infinite Game with Simon Sinek, just about long-term thinking. And then the second one I'd say is Thinking Fast and Slow with Daniel Kahneman. Great book on just biases as it comes to thinking and investing.
Perfect. Question number three: what are you most curious about right now?
Most curious. I'd say it comes back to at least what's so top of mind and what gets me so excited. It's what is that next investment opportunity? Like, I mentioned like the healthcare royalties. We've done whiskey aging. We lend on trucking fleets. We do so many funky niche things that I don't know what is going to pop up in 2025, but I know it's out there. So it's just always kind of searching for that needle in the haystack. That I'm curious what that'll be, but I'm excited to see it.
That's cool. I love that. Next question. Number one leadership quote or theme that you strive to live by.
Oh, you're asking good questions, Brett. I would say it's prioritization, but really what I mean by that, it's focusing on the big things first. So what I mean by that is, and trust me, I'm guilty of this, but I think so many of us, our days are filled with tasks, task management, getting the little things done, being organized. We're on email all day fixing that. And then the big projects we procrastinate on and they fall by the wayside. But the things that really move the needle for you personally, for your learning, your growth, for your organization, those are the big projects that you really need to prioritize. So I know when I'm really fulfilled and doing good work, I actually start the morning with those big projects when my mind is fresh, as opposed to being distracted by all the little tasks that we have to take care of all day long.
So that's good. A good reminder. Next thing, number one way you're using Chat GPT or AI.
I've only really started using it of late, but I have been really, shame on me, I should have been using it earlier, but just really impressed by just like less as a search, more like creative questions I had. For instance, like we just had a brainstorming session here within the organization about how different departments can work creatively with one another. So I went on a ChatGPT and asked that question. We're a financial services firm. Here are the 10 different departments we have. How can compliance work creatively with marketing? How can trading work creatively with financial planning? And it just came up with so many interesting ideas that I had never thought of. So just more from a question asking point of view as opposed to a search point of view, I found it really, really, really creative.
Phenomenal. And the second last question, you scaled to 2 billion and you guys have, X amount of advisors. And you're doing it in a way that's perhaps outside the traditional financial advisor model. It sounds like and feels like.
Yeah.
So what's been the number one secret to scaling to where you're at today?
It is, I would say it's investing in management and leadership and prioritizing that um, s- sooner as opposed to later. Our industry, and we've been guilty of this at times too, we're so focused on growth and hiring that next advisor that it's very advisor driven. I think what we've done a better job of in the last 5, 6, 7 years is treating the business itself and the foundation of the business and the culture, the management of the people, the infrastructure, every bit as important, if not more important. So in other words, within the four walls, to some degree, more important than outside of the four walls. And so building that leadership, that support, that management team, and being intentional around that has just been a game changer for us in terms of scaling the business.
Love it. That's so good. And this is the very last question, Jeff. After all you've accomplished, helping all the people who create and preserve our wealth and all the advisors you help to lead to do the same, how do you best stay centered in your values and then practice a mindset of stewardship over ownership?
Stewardship over ownership. It's not it's not losing focus, staying focused on those core values and not being distracted. They're core values for a reason. And so I love the word stewardship that you use, that comes to mind. And we hit on this when our mission of empowering veteran investors, so much of that is around education, our passion, and we just don't lose sight of this. It's spending our time with our clients and prospects, leaning into it. Their time is our time. I should say our time is their time. We really embrace time with them to make sure they understand the why behind their investments, the why behind the goal setting we're doing with them. We don't want it to just be a trust me strategy because trust me is good until it's not good, until things break down, then the trust is broken. So we really, really look to partner with our clients. And that's a lot of investment on our time, but it comes down to education. And one last point of that in our industry, one of the biggest pitfalls is financial services education. We're not taught this stuff, right? We talk to so many professionals, business owners, lawyers, doctors, you name it, and they come to us and they have really insecurity around investing 101. And so we don't teach this stuff in schools. So going back to stewardship, it's really a passion of ours to continue to educate around this topic because we're really lacking with regards to this in our society.
Jeff Sarti, it's been more than a pleasure having you on the show. Thank you for dropping so much wisdom and value to us here in this last 44 minutes. I want to encourage you to keep using your gifts and talents of being empathetic, really able to connect one-on-one emotionally and in a real authentic way with the clients that you serve and the team members that you lead, as well as continue to be comfortable to veer from the status quo to find especially unique ways to invest that also is risk adjusted and makes just a ton of sense that most people are not seeing those diamonds in the rough. For our listeners who want to get in touch with you, because you're mine one last time, what's the best place for them to find you?
Enjoyed this, Brett. First of all, thanks a lot. Our website, mortonwealth.com, email jsarti at mortonwealth.com, or I'm easy to find on LinkedIn as well.
Amazing. Thank you. Thank you so much. And I also want to thank all of our listeners for listening to another episode of the Building Billions podcast. We're also streaming on Capital Gains Tax Solutions podcast and YouTube channels as well. And we're here to guide the successful entrepreneur, you or investor, on your journey from millions to billions, because that's the journey we're on. Bringing amazing people like Jeff on the show each and every day to level up, to grow, to think outside of the traditional box. And we believe that the key to scaling your business and wealth and compounding your life starts every single day with a mindset and practice of stewardship over ownership, and also applying Billionaire biblical principles. And our ultimate goal is to help you scale so you can give more or all of it away to help MVPs. I'm Brett Swartz. I appreciate everyone listening today. Please review, rate, subscribe, do anything you can to support the YouTube channel or the podcast. As well, check out the book, Building a Capital Gains Tax Exit Plan. If you have a multi-million-dollar Bitcoin business or real estate exit, go to capitalgainstaxsolutions.com for that. Appreciate everyone listening and watching, and we'll talk to you again real soon. Bye now.